Hello traders and welcome back. In this lecture, we're going to be learning about risk management, risks and money management, okay? So these concepts are some of the most important concepts you need to know as a trader in order to be successful, okay? In order to be consistently profitable. You need to properly learn how to manage your risk, how to manage your money, okay? Risk management is kind of as important as technical analysis, as fundamental analysis, as all the other concepts we've learned in past videos. So risk management is that important because when you get risk management right, you basically will make money automatically, okay? So when you can handle your risk management properly and in the right way, you basically always make money because in forex trading, our main purpose is usually minimizing our risk and minimizing how much we lose because losing trades is kind of usual. It's kind of normal in forex trading. Okay, it's not possible for you to kind of win all the trades, but you kind of lose some and win some. And the risk management helps you minimize the amount of trades you lose and minimize your risk to the barest minimum. Okay, so first of all, I'm going to define risk. And then risks can be defined as a situation involving exposure to danger. Okay, so right now, this is basically exposing your capital to danger. That's relating it to forex trading. And then risk management, stroke money management in forex trading is the process of identifying, assessing, and controlling threats to your trading capital and earnings. So by learning about risk management, you'll be able to protect your capital and your earnings. Okay. So it's not enough to make money in the market. It's not enough to win trades. But when you win those trades, you also have to keep your earnings. You don't just win trades and lose trades. You should try as much as possible to keep your earnings. You don't just win and lose because of lack of risk management, but you have to win and also keep them. If you don't keep them, you're basically not making any headway. Okay, so that's very important, and that's what we're going to learn in this module. And then we have five very important. Okay, we have the next point as five very important forex trading risks and money management techniques and concepts we'll be looking at in this course include risk avoidance. That's the number one, risk avoidance. The second one is stop loss or stop losses, and then we have the trailing stops and the break even, then we have correlation, and then we have position sizing. So we are going to look at these six concepts, not five here, but six concepts. Okay, we're going to look at six concepts of risk management and money management in this course, and these are them. So okay, let me just start by explaining risk avoidance, which is the easiest one in my own opinion. So risk avoidance is basically the ability for you to kind of stay away from trades that are not high quality trades, okay, that have lower potential, lower probabilities of being winning trades. So that's risk avoidance. So you just measure the risk and your ability to kind of avoid the trade because of the high level of risk is called risk avoidance. So there are situations whereby you see the market buying, for example. So the market is buying and you have seen the signal to enter. Maybe you came late and then the market continued buying. Now, at the point where the market is presently, you see that the market is kind of overbought, and even though the signal for buying is very much still valid, you don't just want to buy the market like that because the risks involved is high. What do I mean by that? Because there is a high probability that if you buy at that point, the market might retrace, okay? And during the retracement, it might even come and hit your stop loss, okay? So you have the option to either enter the market and then put your stop loss at a very high place, okay? At a very high place, which is increasing your risk, or just avoiding the trade. So you basically avoid trades like that and then just wait for the next setup. Okay, so that's one example. Let me just try to open the charts, okay, to see if I can show you an example of setups like that. Okay, so this is the market. This is the demo account we opened. I'm just going to kind of look for a signal that is quite valid. Okay, so let's look at a signal like this. As you can see, the market is on an uptrend here. So let's assume we got, let's assume we are not seeing all of this, and then we now came to the market and realized that the market has retraced to this point and it's about to go up, okay? And then for some reason, we were not looking at the charts to see a confirmation. And then when we came, we then saw the market at a point like this, right? At a point like this. Let's see, at a point like this. Okay, we saw the market at a point. Okay, let's just say we saw the market at this point, okay, we saw the market, we saw the market at this point. I'll just delete this ones. So we saw the market at this point. Then we know that the buy-in is still valid. If I see the market at this point, I really will not enter this trade. I will just avoid the trade because in my own opinion, there has been a lot of buy-in and there is a high chance of the market actually retracing. In this case, we saw that the market kept buying till this point. So we probably would have still been in profit if we had entered here. But entering here will kind of make you use a stop loss that is kind of this big, okay? Maybe this big, because you want to put the stop loss below the previous swing low, right? So you might want to use a stop loss this big, or maybe below previous support or resistance levels. So basically what I'm saying is your stop loss level will be high, okay, and then it's going to reduce your chances of being profitable. And we can see that, let's assume we entered here and put our stop loss at a point like this, and we were trying to make 2R, right? 2R profit. That's 2 times our risk. So we can see that 2 times our risk is, let's say at this point, okay, we can see that 2 times our risk is at this point. And we probably used a stop loss that is this big. So we can see that the market it didn't hit our 2R and it just came down and then hit our stop loss. So not that the trend is not on our direction, or not that the trend is not valid. The trend is perfectly valid. The only problem is we got late and we could not have the patience or the maturity to kind of avoid the trade. So in cases like this, you just should avoid the trade and then just wait for a good retracement to the major trend line, which in this case is this one, and then you re-enter for a buy. So this is just one of the examples. Okay, this is on daily time frame. Probably on a lower time frame will make more sense because the daily time frame is kind of bigger. So that's just to explain to you what I mean by risk avoidance. So when you see that the risk is too much, when you see that the trade has a lower probability of going in your direction, you just try to avoid the risk. Okay, it's not worth it. Okay, if you want to take trades like this, for example, like this one we just explained, we just made an example with it. If you want to take trades like this, your trade management skills will have to be very good. You have to be able to manage your trade very properly. So you have to be able to kind of trail your stop, okay, or take your trades to break even. So you have to monitor the trades very, very well. So they require more of your attention, more of your efforts. Okay, so but you can just simply avoid the trade and kind of look for a better entry position or entry signal. So that's it about the risk avoidance. In the next lecture, we'll be learning about stop losses, trailing stops, and break even. Okay, so that's what we're going to do in the next lecture. Bye.